This is Rick Rule for Rule Media and the Rule Classroom. Today, we're doing a series of CEO interviews around exhibitors at the Natural Resources Investment Symposium, July 7th through 11th in Boca Raton, Florida. Whether you attend live or whether you attend on live stream, it's important that you get to know our exhibitors, where the rubber meets the road. It's important for you to know, too, that every public company exhibitor at this conference has been personally vetted by myself to the extent that they are owned in my own portfolio. There's no guarantee because I own a stock that it goes up, but there is a guarantee that unlike any other investment conference I know of, every single exhibitor here has been vetted. We conduct a series of interviews with the CEOs so that you can better allocate your time before, during, and after the conference. As I say, the exhibitors are where the rubber meets the road. Remember, too, that these interviews and the conference itself is meant to be enjoyed in conjunction with the lessons that you learned in the Rule classroom. My guest is David Garofalo from Gold Royalty. David Garofalo is a man I've known for many years, going all the way back, I guess, to Hudson Bay Mining. He has a long and successful career in the mining business. And of course, he works with Amir Adnani, who has been a feature at our conferences despite his young years for 2 decades. David, first of all, welcome and thank you for your support of the Natural Resources Investment Symposium.
Delighted to be here, Rick. Thank you.
You have an interesting story to tell in the sense that the assets that started the company were acquired over time during a bear market. They were assembled, one would suggest, literally for dimes on the dollar, and a royalty portfolio was created out of them rather than bought. Tell us something about the genesis of Gold Royalty.
We were spun out of Gold Mining Inc. Back in early 2021 when we went public on the NYSE American. And you're right, we were royalties on our former parent company, Gold Mining Inc., that had assembled a dozen development stage assets, which collectively had about 32 million ounces of gold equivalent resource on them at the bottom of the cycle. And Amir Adnani, my co-founder at Gold Royalty and my business partner, assembled those assets at the bottom of the cycle, 10 cents on the dollar, if you will, and patiently waited for the gold cycle to come back to life as it did in 2019. And that's when he and I first came up with the concept of writing royalties on these development stage assets and creating a separate royalty vehicle. And we did that successfully, 18 royalties initially, none of them cash flowing, but again, a significant mineral endowment underlying those royalty assets, looking to raise $30 million in our IPO. And in fact, raised over 90, had an order book of $140 million and achieved a post-money valuation of $200 million. Having gotten a currency through that IPO process, recognizing that we got a good valuation on those assets, we used our currency to start to roll up some of our peer companies. And over the course of 2021, we bought Ely Gold Royalties, we bought Golden Valley, and we bought Abitibi Royalties. And that added another 150 plus royalties into the portfolio to supplement what was already a significant mineral endowment with those initial 18 royalties.
Part of your history, David, I would suggest, has been as being a master of the M&A game and acquiring companies, acquiring greater heft. I guess, in addition to giving you operational synergies, also gives you increased liquidity and probably a lower cost of capital. Can you talk a bit about the process, in particular the process by which, as an example, you have to be bought by index funds and you get built-in buying?
Scale does matter, and it matters in any business, not just in the royalty business, but clearly in the royalty business, there is a key differentiation between the large cap players in our space and the smaller cap players in the universe, in that Franco, Wheaton, and Royal Gold, which are, I would call, the category killers in the royalty space, have a very significant premium valuation as a result of the significant scale and diversification of the portfolio. They're typically trading at 2 to 3 times price to net asset value, whereas many of the smaller cap players, and that really is the rest of us, are trading at 1 times price to net asset value or below. So achieving that scale helps drive down our cost of capital and really helps us perpetuate our business. At the end of the day, a royalty company is like a bank, singularly focused on the precious metal industry, providing capital. In order to do that cost effectively, you have to have a low cost of capital. So scale does matter. And we're achieving that. We've done that through the M&A that we've done over the course of 2021. but we're also achieving that through other means of growth. We've been doing project financings, we've acquired 30 third-party royalties, and we've also generated our own royalties organically on a very cost-effective basis.
Let's now examine what you consider to be some of the more important key royalties that people can focus on to understand the value inherent in gold royalties.
With over 240 royalties in our portfolio, we clearly have a lot of optionality. We have a lot of early stage royalties, but we have royalties right through the life cycle of a mine, from exploration stage right through the production. We have 6 that are producing currently. We have another 14 in various stages of construction, which is providing us 60% compounded annual growth in our revenue right through the end of the decade. This year alone, we're seeing a doubling in revenue as some of our more significant assets come into production and are delivering significant royalty revenues. So it's not just a quantity proposition. We certainly have that. We have a lot of optionality with early stage royalty opportunities. In fact, it's almost like having an ETF in the junior sector. We have so much junior exposure in terms of early stage royalty opportunities. As an investor, you don't need to pick the juniors out there. We've done that for you, in that we have a significantly diversified portfolio of royalties on these junior owned properties, and you don't have to worry about dilution as a result of them raising capital, because we own our royalties outright. They're bought and paid for. We're never going to suffer any dilution. We never have any capital costs from these. So we provide that kind of ETF optionality that you might be looking for in the junior space, without having to be singularly focused on one junior versus another. But it's not just a quantity proposition, it's a quality one as well. And that we have royalties on 3 of the 5 biggest producing gold mines in North America. We have a royalty on Canadian Malartic. We have a royalty on Côté, which IAMGOLD has just brought into production. It's going to be Canada's 2nd biggest producing gold mine. And we have a royalty on the underground extension of Goldstrike, which is the biggest producing gold mine in the US. And that is an exclusive royalty on the underground extension, which is called Ren at Goldstrike. So we have royalties on 3 assets that have 30 years plus of reserves ahead of them. So we have a foundational element to our story that will provide an annuity for our shareholders for many years to come. And a lot of our growth is in fact coming from those large scale operations run by large cap companies that have the balance sheet and technical capacity to optimize those assets.
It's important for our viewers to understand that these very, very, very large assets almost always generate surprises. And those surprises are almost always positive. When David talks about these 3 world-class mines, one needs to be reminded that Franco-Nevada started by paying, I think it was $2 million US for the Goldstrike royalty, which has now generated over over $1 billion in royalty payments, and has the same reserve number now as it did when they started 30 years ago. It's important that people understand the upside associated with this. It's important to understand, too, that this upside is achieved in terms of capital cost expenditure and exploration expenditure at absolutely no cost to the royalty holder. Basically, David, on an operating basis, your gross is your net. Is that correct?
That's absolutely right. We have a very low cost structure, and we have 8 full-time equivalent employees, and we could run a business 10 times the size with the same number of people. So that means every incremental dollar of revenue growth falls right to the bottom line. And that's important. We have $7 million of cash G&A costs to run our business. This year, we're going to be generating north of $11 million of royalty revenue. That's doubling from where we were last year. And for the first time in our history, and this is remarkable for a company that's only 3 years old, it was a startup, we're in free cash flow positive territory, and we're seeing revenue growth through the end of the decade using long-term consensus gold prices of sub $1,900 an ounce of about $60 million of revenue. Again, largely driven from those large-scale operations that are being expanded and scaled up over time. That's significant free cash flow growth right through the end of this decade.
Ladies and gentlemen, understand, he said $1,900 an ounce. If you juxtapose that number with the current number, $2,300 an ounce, there's some icing on the cake. You need to decide for yourself whether this price maintains itself, whether it goes higher, whether it goes lower. But it's interesting, the dichotomy between the $1,900 price forecast and the $2,300 price that we currently enjoy. I want to move on now to the process by which you create value, both in the context of merchant banking around your existing assets, but then also in the context of royalty acquisition, including your most recently announced joint venture with Taurus?
Yeah, look, you have to be able to grow through multiple means because sometimes the windows open up in certain components of your growth strategy and close in other areas. And for example, when we had strong currency back in 2021 post our IPO, the M&A market was open for us, and we used our currency to roll up three of our competitors and did it on a very cost-effective basis because we had a multiple far superior to theirs. So it was very accretive for our shareholders. When the Federal Reserve started tightening in early 2022 and we saw a significant downdraft in gold equity valuations, our currency abandoned us, and we said, well, we're going to have to find other ways to grow. And we grew through doing project financings where we provided capital to explorers, developers, and operators to help them optimize and grow out their operations and development stage projects. We did third-party royalty acquisitions where parties were looking to crystallize values on royalties that they already owned. And then we generate royalties organically, principally in our Quebec and Ontario bases, where we have a small team in each of those bases that stake exploration claims around existing operations, farm the properties out, and take royalties back in return. In fact, we generate 2 to 3 royalties effectively for free through our sweat equity doing that every quarter. Last year, we generated about 15 royalties doing that. Overall, of our 240 plus royalty portfolio, we've generated 60 royalties organically. So not only do we do those for free, we actually get option payments on those properties. Last year, we generated about $3 million of option revenue on the royalties we created. So we're not only getting them for free, we're getting paid to generate those royalties. So we grow through multiple means, and I think that's really quite unique among the royalty universe.
Uh, I need to ask you a question related to an answer you gave earlier in this interview. At the beginning of the interview, I think I heard you say that you think revenue grows at 60% compounded from your existing asset base through the rest of the decade. Is that accurate?
It is, and that's on a consensus basis. I'm not pulling that out of our own models. That's what the analysts, we have 7 sell side analysts that cover us right now. So I'm citing their own consensus estimates of the growth that we have inherent in our existing portfolio, which again is completely bought and paid for. If we did nothing else other than sit on the assets we currently own, what analysts are saying is we're going to see 60% compounded annual growth in our revenue through the end of the decade. And now that we're in free cash flow territory for the first time in our 3-year history, that means every incremental dollar of that revenue growth falls right to the bottom line and enhances our free cash flow profile.
And speaking of cash and cash flow, how much ammo do you have to grow right now?
Well, we have a $35 million line of credit with Bank of Montreal and National Bank Financial that's substantially undrawn. But what we've been able to demonstrate is we can access capital when we have a use of proceeds. For example, we acquired a royalty on the Borborema project in Brazil that Aura is building out and is expected to be in production in the first quarter of next year. We acquired that $31 million royalty with a $40 million offering through 2 strategic investors, Taurus Funds out of Australia and Queens Road Capital out of Hong Kong, that provide us very attractive terms on 5-year unsecured money on a convertible debenture to finance that acquisition. So we can be creative when we are able to demonstrate that we have an accretive acquisition to make. That royalty opportunity we expect will generate anywhere from 15 to 30% rate of return against the cost of capital on that debenture of about 10%.
That's an amazing story. David, our attendees are encouraged to get in touch with our exhibitors before the conference, during the conference, and after the conference. They need somebody to be in touch with. For people who want to know more, both the online people and the people who attend in person, who at the company should they be in touch with, and how precisely do they get in touch with that person?
Well, our Director of Investor Relations and Corporate Development is Peter Benke, and many of our investors know him already, but Peter is at Benke, PBENCHCKE, at goldroyalty.com, or you can reach me, David Garofalo, D Garofalo, DGAROFALO, at goldroyalty.com. We'd be delighted to hear from you.
Your efforts on behalf of shareholders, me included, Thank you, too, for your ongoing sponsorship of the Natural Resources Investment Symposium. I look forward to seeing you in Boca Raton, Florida, July 7 through 11. It's been a pleasure talking with you.
Likewise, Rick. Thank you.